It's worth talking a little bit about the bond market. People in their day-to-day life while they have experience with debt or loans, they don't really necessarily may not have much knowledge about bond market. So the first thing is don't freak out because a bond is just a debt. Okay, a bond is just a debt. It specifies an interest rate, how often interest payments are made, when principal payments are made, and so forth. So a bond is at its core a debt. What makes a bond is that there's a legal structure that allows it to be traded on public exchanges. So it's registered with the Securities Exchange Commission, and if you or I had a brokerage account, we could buy and sell bonds. Um, so the term you'll hear frequently is that they are marketable securities. So marketable means marketable to the general investing public. Now, you have to learn some of the conventions. So bonds are sold in $1,000 face value increments. So if you have a $100,000 issuance, there's actually 1,000 separate bonds that could be sold. So, and the reason for that is you want to be able to sell to many different people. There are a lot more people who have $1,000 or around $1,000 than who have $100,000 to buy bonds. So here's how markets are quoted. They're quoted as percentages. So in this example, 99 dash a half means 99.5%. So 99.5%, if you're going to buy 10 bonds, would cost you $9,950. You need to know this bond quotation system because it will be used in some problems, and frankly, it's going to speed it up for you. Another real quick example, if you got 101 was your quote, 1.01 times 10,000 equal 10,100 would be the price. Okay. So a bond, the name, often gives you some information about either the risk of the bond and or the structure of the cash flows. Okay, so what follows here is just a bunch of different bonds and bond features. These are questions that might come up in a multiple choice or conceptual question. We're going to deal with one kind of bond in particular for the accounting, and it's the one that's most common in the corporate bond market. It's called a debenture bond. This type of bond is an unsecured debt with interest payments only and the face value due at maturity. Okay, so that's the one we're going to deal with. It's called a debenture. Excuse me. There are secured bonds and unsecured bonds. So secured bonds have some type of collateral. You might lend an airline money and use the jets as security. A debenture is an unsecured bond. Convertible bonds, those are bonds that can be traded typically or converted typically into the stock of the issuing corporation. Commodity-backed bonds, their value might be tied to something like gold or oil. These are for companies that mine gold or drill oil. It enables them to hedge their risk of financing. We talked about zero interest bonds. They're also what are called deep discount. So there might be a small token amount of interest, but nowhere near the market rate. Bearer bonds. Oh, I like these. These are kind of cool. It's not recorded and is transferred by physical transfer of the bond, which is a piece of paper. If you watch any of those spy movies and there's some type of ransom, oftentimes they'll be asked to be paid in bearer bonds. If you have the paper, you get the money. A lot of wealthy people store these in safe deposit boxes around the world as a kind of a safety net. So bearer bonds are kind of cool. Won't do the accounting for them, but it's kind of cool. Income and revenue bonds. Now these two are the kind of bond that you're likely to run into if you work for local or regional government and state government. So the income bond, it says unless the company pays a profit, but it also might be for something owned by a government entity, like let's say a sewage treatment plant or a power plant if it's owned by a government entity. Also, revenue bonds. A lot of government projects are built with revenue bonds. So, for example, the convention center in St. Louis, the convention center hotel, the hotel tax is tied to a bond. Parking garages, often tied to the revenue that are owned by municipalities, often tied to the revenue generated by the parking garages. Um, Water projects and other kind of things can be tied to the fees charged by the government in the future. So revenue bonds are a very popular source of funding for governments. So you're very likely to see those if you audit government or if you work for local government. A school district, they'll have a bond issued against the district taxes. Okay. All right. Now, as a liability, the bonds may be assets if they're investments, but in this chapter, we're looking at the liability side. Even though they have market quoted prices, on the liability side, they will be held at amortized cost, which is what we did above with the zero. We adjusted using the rate at issuance. So when they're held as assets, they may be fair value, maybe not, but they may be. You learn about this when you cover investments, which is in 303. Our bond problems. Once again, we're going to deal with corporate debenture bonds. And we're going to talk about that on the next video. These bonds are going to have semi-annual interest payments and the principal due at maturity.